Hi there, I am Jonathan Dio, President of Dio Wealth Management, founder of the Happiness Dividend blog and the Mindful Money Toolbox. Looking at the outstanding performance of large U.S. companies in the last couple of years, it's natural that people start questioning the merits of diversification. Although an asset allocation portfolio has delivered lower recent returns than the S&P 500 at the end of 2014, it's important to remember the role diversification plays in the long-term protection of those portfolios. By definition, an asset allocation portfolio owns some big companies and some small companies and some domestic companies and some international companies, emerging markets, and maybe even some fixed income. Because of this, returns depend on a greater variety of economic inputs and companies, and so they should be less volatile, both on the upside and the downside. In 2013 and 2014, the asset allocation portfolio underperformed the S&P 500 significantly, and in 2008, it outperformed just as significantly. In addition, the asset allocation portfolio recovered its pre-crisis highs long before the S&P 500 could say the same. In other words, the asset allocation portfolio spent less time in negative territory. In this way, asset allocation is the tortoise to the concentrated portfolio's hare. The hardest time to hold the asset allocation portfolio is when large returns are being had in some index away from you. This often happens towards the end of a bull market. And media, constantly extolling the benefits of the S&P 500 as they have, only serves to heighten the anxiety that maybe we should be doing something better. And we've got to admit, you could be doing better. You could have been all in on the S&P 500 in 2013 and 2014, and you would have made a lot more money. But this wasn't known in early 2013 and 2014, and it says exactly nothing for what's going to happen over the next year or decade. The S&P 500 underperforming for some period of time does not make asset allocation wrong. It's merely the time where you, the asset allocator, have signed up to underperform intentionally. I promise you that when the shoe is on the other foot, when there are market challenges, it is the S&P 500 investor who wishes they were asset allocated. Buying the S&P 500 or any single stock index commits you to big ups and big downs, as that particular index wins and loses the popularity contest with investors. Asset allocation is a process of investing that balances the risk and the return and reflects that in your financial plan. When more and more people start to worry about their underperformance relative to the benchmark du jour, NASDAQ in the late 90s, S&P 500 today, some of them will trade out of their beautifully asset allocated portfolios and chase the dream. As this happens, it will begin to drive markets even higher and make you feel even worse. It's at this precise moment that you need to hold even tighter to that asset allocation, even while all the market commentary questions your intelligence. Asset allocation, broad diversification, and rebalancing are your best friends in investing. Oh, but what if I just ride the S&P to the top and then trade into an asset allocation portfolio there? Sure, no one's ever thought of that. Well, actually, people think about this at every cycle, but the market doesn't ring a bell at the top or the bottom. And all those people end up trapped or destroyed. If you're asset allocated, you're doing the right thing. Just remember that when some market somewhere skyrockets, only some small portion of your portfolio will be involved, and the rest will bring down the average for now, and that's okay. So what should you do? It's simple. Keep dollar cost averaging into your beautifully asset allocated portfolio, and then go spend some time with your friends and your family. Thanks for listening, and good luck.